Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about FHFA Director Bill Pulte calling for Fed Chair Jerome Powell to be investigated, as well as mortgage rates and the ADP jobs report. Logan, welcome back to the podcast.
It is Jobs Thursday morning. By the time this comes out, the jobless claims data, the BLS jobs report, the things that really matter for this week. But what a week, get the popcorn out, get the Pepsi drink out, put the legs up on the movie theater and sit down and watch this crazy second half of 2025.
Okay, so we are recording this on Wednesday about noon, and we broke the story this morning. You actually helped break this story. The fact that the FHFA director, the Fannie Mae chairman, they are the same person, Bill Pulte, is calling on Congress to investigate Jerome Powell based on what he said was congressional testimony that he said was not true, some other things. So that's a very interesting story. So their full court press on Powell continues.
Not shocking. This is what we kind of expected, a full court press. To me, this is the more interesting aspect on this is, let's just do a hypothetical. Let's just say the next few months, the labor data starts to underperform. And because we're not at neutral policy yet, because the Federal Reserve, what they tell you, because what I think and what everyone else thinks is irrelevant, they will tell you they are still modestly restrictive.
Right.
It puts the onus on them that they can't have the labor market starting to break because they're the ones that raise the inflation expectations for 2025. They're the ones that are saying, well, it hasn't happened yet. Well, it'll happen in the second half. So the onus is on them because a lot of people are still forecasting that the growth rate of inflation, because it's come down so much, has the capacity to go up. But then if you're doing a push or pull, if the labor data starts to get weaker, then, the ball's on their court on that side. And this is the predicament they put themselves in by not getting to neutral policy. If they're a neutral policy, then they're going to say, well, we're not that far from getting to an accommodative policy and we could get there very quickly. So then it just becomes a very interesting second half because to me, the ADP report came out negative 33,000. The ADP report and BLS are having a gap in about two of the job sectors in America, healthcare services, and what's happening is that the BLS report is noticeably higher than that. The bond market doesn't, or nor should it really care that much because the job openings data came in fine. So whatever it is this morning, we'll keep an eye on how the bond market reacts to it. There's also some stuff that is going on with the UK with their budget and how their bond yields have reacted. So I don't want to bore people too much with that. But yeah, lots happened. And we still have one more day left before July the 4th.
So my question is, does that ADP data give you any insight into what you think we're going to see on Jobs Friday/Thursday?
There have been times where the ADP report is much stronger than the BLS. There's times where they're much softer. I would tell you this: the job openings data, even though it's lagging, the market puts more weight on that because they know the Federal Reserve puts more weight on that. The ADP report is the least the least important data line. So they typically do trend together over time. If you look at it on a longer time frame, if ADP gets weaker, headline jobs gets weaker. But for ourselves, because the labor force growth is not picking up, we're going to have less people looking for work. And this is what we talked about before the year started and early in the year, that we have to keep an eye on the labor force growth, because if there's less people looking for work, it's a little bit harder for the unemployment rate to go up higher. So you can have like 6 straight months of 80 to 90,000 jobs being created and not have the unemployment rate move too much. So everyone's keeping an eye on what we call technically the break evens, but that's why I talked about it so much early on. So we'll see how the report is, but the job openings data was fine. The jobless claims data, the continuing claims, is starting to pick up a little bit more. in the last few weeks. Of course, small business gets impacted a little bit more with trade war tap dance. Not sure, what everything's going. So we'll see. But it didn't shock me right away when the 10-year yield didn't react much to the job openings. I was going on X and saying, yawn, yawn. Really, this is not. If the job openings data was really bad, and then the ADP got it, then you got something. But I think that's how I try to explain what happened Wednesday morning.
It's interesting to me that that Bill Pulte picked today to be like, Congress should investigate Powell, because it feels like this week we could get lower rates just because of what the data says. We don't know that for sure, but it feels like an interesting thing. Like, wouldn't you just wait to see what the jobs report says? Because you might get lower rates just doing that, because that's really their goal.
So what the president wants is like recessionary Fed funds rates. He wants an accommodative policy. That is so different from what I'm talking about, because to warrant those kind of rates very fast, a lot of this is because of the budget. It's problematic right now. You see what's happening with the tax bill. They've got to do some accounting stuff to make the numbers work. But if the Fed funds rate was much lower, the interest payment is much lower, right? So they have more wiggle room. We talked about this late last year that, don't be shocked if something happens in 2025, to try to make the budget work because the interest payments. This is what's occurring right now. So normally you would say, why does Trump want that many rate cuts? Is the economy going to recession? A lot of this is budget related. For me, it's always about getting to neutral, because the Fed is always going to be behind the curve. But the 10-year yield had fallen a lot recently. And, when we're down here, the market is already getting that next rate cut in. It looks about right, right? The 10-year yield doesn't look that odd to me when you think about Fed policy where it is. But if the report this morning on Friday or Thursday comes out weaker, we'll see how the bond market reacts to it. Or if it's just an average report, you might not get too much movement. But we've already had a noticeable move lower. The dollar is already noticeably lower out there. Energy prices are lower this year than, or oil prices are lower this year than they have been in recent years. So we've always said that the trifecta, the trinity, Trump needs about the 10-year yield just to get a little bit lower. If he just got 3.80 to 4%, they'd be perfectly happy. But what he wants is to make that budget work for that deficit and the tax bill. And it looks like they'll still get something done with the tax bill, but it's just much more difficult. The numbers get harder, right? Every decade we go out, the mandatory payout gets bigger and bigger just because we have a growing population out there.
Okay, so
an aging population, excuse me.
Either one. So we are getting towards the lows of the year in mortgage rates, but your forecast is 5.75 to 7.25, right? Like, your mortgage rate forecast for 2025 is that. So you're just hoping to get down towards 6%. You really don't see something that could move it down into the fives unless we see a real recession, right?
So again, we always like to target the 10-year yield first rather than mortgage rates. So the 10-year yield range is 470 on the top end, 380, right? The corridor line at 380. If the labor data starts to get weaker, right, the 10-year yield will go there without any rate cuts, right? So last year, what happened, it was the market really was anticipating so much weakness in the labor market that they took the 10-year yield and broke it through the corridor line. And it's like, it's not really breaking yet, so it just shot right back up. Now it's getting different. We were going to get 2 rate cuts regardless of tariffs anyway. But if you get 2 rate cuts in, getting down just toward 4.25% and 4% becomes much easier, right? Getting higher becomes a much more harder task. You're really going to need economic growth, the labor market to be good, and inflation to pick up to warrant higher yields above 470 or even in that range. So the 10-year yield looks right. The spreads are getting better, especially on the days where yields go up. So we're close to the year-to-date lows, but we're about halfway in to the forecast. That second wave down lower needs weaker economic data where Fed policy is. Last year, we saw that the market play their hands with the 10-year yield. 2023, the Gandalf line, you shall not pass. I was like, if we break below 3.37, we're going into recession. I don't see that in the data yet. 8 different times that sucker was being tested, reversed every single time. So here, again, breaking, if the labor market is breaking, you got lower rates for longer. End of story, right? The whole dynamic changes. We're quite not there yet. That's why we have to focus on jobless claims at this point, residential construction workers out there. So it really becomes a unique challenge. I wonder if the Federal Reserve probably is thinking to themselves, maybe they should not have raised the inflation expectations as high as they wanted, because I think, just personally, I think they thought the inflation data would be hotter by now. So we're going to have this jobs report. We're going to have another CPI report, PCE report, all before kind of, we'll have another CPI and jobs report before the Fed meets. So that July meeting becomes very there's going to be a lot of different takes on it. But for me personally, how they have reacted, they don't cut in July unless jobless claims are breaking. So I'm kind of telling everybody, even if we get a weak report, this is not the Federal Reserve that gets ahead of the curve. This is the Federal Reserve that tells you what they told the New York Times. We wait. We play catch up. Last year, we waited too long to cut rates, so we had to play catch up. So the only 2 times they're talking about cuts is catch up mode, behind the curve, old and slow. That's how they operate. They're not ahead of this in this regards. And Powell admitted it. The Cleveland Fed president admitted it. So I'm going to take them to their word until they prove me wrong with their actions. But their actions always tell me behind, slow, on purpose.
So we've had Powell talk about a July rate cut. Bowman's talked about a July rate cut. But from your perspective, that's less important than what the labor market does.
I still think that they need to see more labor weakness. The job openings data is very key to them. That report did not have breaking in it. So the jobless claims data is always the key. That's the fastest data line for deterioration of the labor market. We're going to get that Thursday morning. But again, Powell kind of said, hey, rates are a little bit lower. We saw that purchase application data came out today. And again, people are just like head scratching. 22 weeks straight of year-over-year growth, 9 straight weeks of double-digit year-over-year growth. This week, one thing I always tell people, we never use the week-to-week unadjusted numbers because that showed 10% week-to-week growth. It was like 0.1%. You use the adjusted numbers. But again, 16% year-over-year growth. That's 9 straight weeks of double-digit year-over-year growth. So the bar is low, new listings data is up and everything, but it's still, to me, people are starting to have to talk about it now because it's gone, but I still see the takes not quite up to par yet. And to be fair, a lot of these people aren't housing analysts or have tracked this data line to know the percentages and what's going on in 2025.
It's so interesting. You've talked to several media outlets who seemingly were very surprised at the positive take you have on housing. You're not saying, wow, things are going gangbusters, but you're like, you do have to look at the purchase application data and say we're seeing this demand even with rates this high.
I think the misconception is, pricing is cooling down. That's a function of supply growing, not because home sales are crashing. Just, home sales had the fastest crash in 2022. Price growth cooled down. 2023, home sales didn't really go anywhere, but pricing was a little bit firmer. That's a function of supply, right? Supply was much lower in 2023. This is why the whole team higher rates, because it's not a functioning marketplace. So I think there's just a lot of confusion. And I see that people are like looking at the purchase apps, are what's going on here? Inventory historically is still low, but when you have so much price inflation in such a short amount of time, when inventory grows, the supply gets bigger, there's more choices, but that affordability band hits the buyers in the pool. So naturally prices got to cool down. That's the whole wish. That's the whole chef kiss. That's why I love 2025. But I think a lot of people just like doom porn. So it is interesting because when people visually see the charts we show them, they're like, what? And then, of course, if you have the tracker data, if you read the weekend tracker, you think about it, you're so much ahead of 99.999%
True.
of the people in the world because they're like still looking at stale data. So the next 2 weeks, of course, the tracker is going to get hit by the July the 4th holiday weekend. But after that, we'll take it from there. We'll see what happens with the rates. But it gets a little bit more interesting for me because I've only seen the data like noticeably get better when rates go from 6.64 to 6. And we just saw a little bit of stabilization in the data, and it's clear to us. But again, if you wait 3 months, you'll see it in the existing home sales report. We don't want to be like the Fed. We're not old and slow here. We are current and forward, and that's how we've operated since the Peloponnesian War, Sarah.
Is it though? Is it?
It is. It is. I've been on this planet for a very, very long time.
Oh my gosh. So funny. Okay, let's talk a little bit about that demand because when you say like, okay, we've had all these 22 weeks of positive purchase application data. No, not huge, but more. What does that end up volume wise by the end of the year? Like, what do you expect home sales to be?
To me, because again, one of the things we've always tried to stress with purchase apps, it can take 30 to 90 days before it hits the sales data. Okay, so the last 2 years, purchase apps were growing 8 weeks, 12 weeks, back-to-back years, and then it stopped because rates went up higher. And I always go, that's it. That's the peak of sales, the monthly sales. Here, that isn't the case, but you might get some of this demand in the next report, or you get maybe more of it in 2 months. Our weekly pending sales data and our total pending are kind of positive year over year. So we're seeing it. It just takes a little bit of time to get into the existing, and it's not much. I mean, I think the existing home sales forecast, which I would agree with, is like 4.2 million. It's not like a thrusting demand out there, but when you have new listings data grow on a year over year basis, those sellers are buyers, so it boosts up the purchase application data. That's what's happening this year. So if we start to see noticeable demand, our weeklies and pending sales will have a lot more growth year over year. But also, if the demand was even better, the weekly purchase application data would even improve better. Like last year, we saw that. We saw no year over year growth with purchase apps, but the weeklies were noticeably better. It gave us a couple 100,000 home sales from like the three, like, from the low 3,800,000 up to like 4.2 million, stuff like that. That it's a material change with the year, but in grand schemes, not much happened last year with existing home sales. So it is going to be very interesting to me to see if we make that next move lowered rates. How does the demand look now? It should perform better on the week to week data because the year over year growth has been at double digits for 9 weeks now.
So we have that positive purchase application data, but that's just application. How many of those applications fall out? Like, what is the
majority of them are in? A lot of people make a big deal about Redfin's like most cancellation. I encourage everyone go look at that chart. Go look at that chart for the last like 7 years. To me, Redfin's cancellation rates, a material change would be probably in the 20s, 23 to 27%. It's like 0.6% higher than last year. Majority of apps do go through. This is why our pending sales are up out there. So it does fall through. I would say cash buyers as a percentage of sales are down. But in terms of most people that fill out an application, majority of them get through. But Redfin's data is a little bit higher on a year over year basis. And a lot of people are talking about, well, there's like the highest rejection on mortgage applications. Logan, you're not reading it. I said, homie, go read the sentence. It says refinance, not purchases. And there are 42% of purchases aren't being declined. You know what? If men just start to read a couple sentences, so much of the clarity would be there. But they just look at a headline and they go, oh, and then they go, I say, did you read the article? They go, no. I'm like, oh my God, you're one of them. You are one of them that I've been battling for 14 years. And why do we say the history of human civilization? Those that read have a benefit over those who don't read, and burning books are a bad thing. You should read them.
And
But
listen, I mean, we write headlines. It's hard to fit stuff in a headline, right? To get it to be the right size. You're like, oh, it's digital. Okay, but the search engines wanted to, you have to optimize for that. So I'm just telling you, if you only read headlines, you are getting such a small percentage of what's actually going on. That's just my
what's the
media
running
tip.
joke I've had, Sarah, is that I on April Fools, I do a doomsday article. I did a doomsday article on April 1st, 2017. Every April Fool's, I do the same article. I just replete it. And because the article has the U.S. is going into recession, it's the most popular thing I've ever written, because men are just like Pavlo dogs. They go, oh my God, doom porn, my miserable life. I have to go read it. And they read it. And at the bottom, I said, if you're the person that shared this article before you read it, you're the jackass I'm talking about. And still to this day, some of the same guys still fall for it. It's like 7 years. Even they go, Logan got me again. Reading is a good thing. Looking at charts is a good thing. That's why we do crayon economics. We just draw those black lines to make it seem, okay, this was happening here. It is not happening here. So it's the world we live in. What do I say? Pilgrim in an unholy land. But some of us have to do this job.
Well, Logan, thank you so much for being on. Of course, we'll talk tomorrow too, after that jobs report comes out. Thanks for being on. This week ended up being, because we had so much news, economic news, you're going to be on 4 times this week.
Yes, and remember, Chart Daddy, get in shape 6 minutes. Start doing your jumpy jacks, start doing your push-ups, start doing your stretches.
I reject that whole notion. All right, we'll talk to you soon. Thanks.